The biggest threat facing the stock market today, guys, is the Federal Reserve. Oh, wait a minute. There's other factors in play. What all the other factors in play even after the Federal Reserve tanked the market over the past couple days? Well, hello, everybody. This is Anthony Grasso bringing you financial news that you can use. And I'm going to answer that one question. But first, as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell if you like your daily stock reviews and recommendations from an unbiased source. All right. So, yes, I agree. The Federal Reserve has had a hand to play on tanking the market. First off, I never thought we were going to raise the rates immediately and then turn and start decreasing them. I always thought they were going to hold them for a long time high up. And they said that, and investors didn't like that, and it tanked. Have we hit the bottom yet, or is there other things in play? Now, I want to focus on earnings going forward of stocks in general. Right now, we're in a seasonally weak time of the year for earnings revisions. We are still in high inflation that's definitely eating into the margins and overall demand of everything. Now, there's a few indicators that suggest margin pressure and earnings growth risk. All right, first off, let's look at, I want to examine what are the risks to stocks going forward. Now, the forward sales growth and the rate of change on the producer price index, we got to look at. Now, bringing up the producer price index, we have a decline in goods and services. Inflation is definitely kicking into people's pocketbooks right now, and it is starting to show everywhere. Now, another indicator I want to quickly look at is the nominal wage growth. The nominal GDP growth and the wage growth. Now, there has been real negative income growth. There's been high inflation, tighter credit, and falling consumer confidence. I'm going to bring it back over here. Now, here's what we need to look at for the near future, going into the quarters going forward. The personal consumer's expenditure in the future, they might decline even farther than what they are from right now. I think inflation numbers are lagging indicators for personal consumption because I believe most people could eat the higher costs short term, but now we got to look at the long-term effects on personal consumption with the higher inflation. I believe those numbers are most likely to fall, but we also have to look at the quarters moving forward. And also, when I'm reviewing stocks for this channel, I look at the growth expectations and earnings for companies projected going into the future. Now, each quarter, those gets revised on each company. Now, when we start seeing significant downward expectations, that will bottom some stocks. So are we at the bottom yet? Now, I don't really think we're at the exact bottom yet. I think the Fed tightening has just started to hit the economic conditions right now, and that the next hurdle is going to see how the falling GDP growth expectations and possibly a downward earnings revisions. So what are your thoughts? Do you think this is going to improve over the near term after the Fed tanked it? Or do you think with the higher inflation that's still affecting everybody right now, it's going to have long term? But what are your thoughts? Please leave your comments down below. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell if you like your daily stock reviews and recommendations from an unbiased source. Until the next stock update video shortly after this video, folks. Ciao.